The S&P 500 has been on a bull run in the past year, growing by over 20%. In fact, over the past 50 years, the S&P 500 has returned an average of 10% per year. To put these amazing returns into perspective, if we had invested £400 each month over the past 50 years, compounding at an average rate of return of 10% per year, the value of our investment would now be almost £7 million. So given this outstanding long-term performance, should we just consistently invest in an S&P 500 index fund and not bother with investing in anything else?
I'd buy the S&P in a second.
We all know that past performance is not an indicator of future performance, and there is no guarantee that we will get the same returns in the next 50 years. But the S&P 500 has proven to be really tough to beat over the long run. Studies show that over a 15-year period, more than 90% of investment professionals failed to outperform it. Even in the short term, more than 50% of active managers failed to beat the market. So the majority of the best hedge funds and institutional investors haven't been able to beat the returns of an S&P 500 index fund that you and I invest in. This really does make you question whether there is any point in buying anything other than that. Another advantage of investing in an S&P 500 index fund is that it's extremely cheap. For example, the Vanguard S&P 500 ETF has ongoing costs of only 0.07% per year. In the US, the same fund costs only 0.03% per year. Therefore, because it costs so little to buy and hold an S&P 500 fund, you'll benefit by keeping nearly all of your investment return. If you venture into products with higher fees and fewer holdings, you potentially stand to lose more while trying to earn higher returns. This being said, here is why many people, including myself, choose not to invest solely in the S&P 500. First of all, the issue with this approach is that while it claims to diversify your money across 500 companies from various sectors of the US economy, the majority of our investment will in reality be concentrated in the top stocks. Since all these companies on the index are weighted according to their size or market cap, it means that the bigger a company is, the bigger their share of the index. This also implies that their weightings will always change depending on their size. While this does ensure that we will always be invested in the top performing businesses in the United States, the point is that the largest companies are always going to dominate the composition of the index. For example, Microsoft is the largest company on the index right now. So if you were to invest £100 or dollars in an S&P 500 index fund, 6.96% of your money would be invested in Microsoft, then Apple would get 6.78% and so on. If you look at only the top 10 companies of the S&P 500, they account for 30% of the entire index, and the top 25 stocks represent 44%. So while you're investing in 500 stocks, the returns of the index will actually be dependent on the performance of the top 20 to 30 companies. We actually saw this recently with the top AI stocks driving up the index's performance this past year. As these companies' market cap gets bigger and bigger due to the AI hype train, they will account for an even larger proportion of the index. By the way, this is the case with most indices that use a market cap weighting structure, not just the S&P 500. Many argue that this weighting method presents a real problem because we are reliant on the top companies to keep performing year after year to help our wealth grow. That's why critics of index fund investing believe that the better alternative is to invest in an equal weight index, as you would spread the money evenly across all the companies. The point is that while it does benefit our portfolio greatly when these top companies thrive, when they experience a challenging period, it will have an impact on the performance of the entire S&P 500.
If Apple has serious problems, then the S&P is going to have serious problems.
At the same time, the fact that the index includes only large cap stocks means that you'll be missing out on thousands of smaller American companies that have the potential to 10x. As you can see from this chart, over the past 10 years, the S&P 500 has returned an average of almost 12% per year, which is not bad at all. However, the entire US stock market index, which includes the S&P 500 inside of it, but many small and mid-sized companies as well, has returned almost 14%. So even though they can be more volatile, those smaller stocks have more growth potential than the already established larger stocks. In fact, Vanguard's founder, Jack Bogle, has always said that the total stock market index that tracks all the investable companies in the United States makes more sense to him.
My preferred index fund happens to be the total stock market, which includes large, medium, and small stocks.
Before we continue, do me a huge favor and hit the subscribe button if you're enjoying this video so far. Thank you. Another thing to consider is that while the S&P 500 is the largest stock market in the world, investing solely in the US may mean missing out on significant growth opportunities in other global markets. There are some great international companies out there like Alibaba in China or Samsung in Korea that you will miss out on by simply putting all your chips on the United States. This kind of geographical diversification is really important because sometimes European markets may be performing well while the US one may not. The most recent example that I can give you is from 2022 when the FTSE 100 was up by 5%, whereas the S&P 500 was down by over 10%. The reason for this was the performance of the energy sector, which surpassed other sectors by a wide margin. And since more than 15% of the FTSE 100 is represented by energy stocks, the index reaped the benefits. Financial stocks also benefited from rising interest rates, and there are many of these in the FTSE 100 too. On the other hand, the tech stocks in the S&P 500 were crushed during that time. It goes to show that, in my opinion, relying solely on a single market is suboptimal. Despite its outstanding long-term performance, it's also important to remember that markets can remain flat for extended periods of time. For instance, the S&P 500 showed zero returns between 1999 and 2013. Imagine being solely invested in the S&P 500 and waiting 14 years to see your portfolio grow again. Something to keep in mind. Now, many people argue that when we compare the past performance of the S&P 500 to that of a global index fund, the S&P 500 tends to beat it. As you can see from this chart, this Vanguard S&P 500 ETF has returned 12% per year in the past 10 years, while a global index fund, such as the All World ETF, has returned only about 8% per year on average. This raises the following question. If the S&P 500 has beaten a global fund which tracks all the investable markets in the world, what's the point of including anything else in our portfolio? Well, first of all, as we've already mentioned, past performance is not an indicator of future performance. Just because the S&P 500 has outperformed a global fund in the past 10 years doesn't necessarily mean that we should exclude other markets from our portfolio, because there is no guarantee that the US will continue to outperform. When we analyze the outlook for emerging markets, for example, Goldman Sachs forecasts that the emerging markets share of the global stock market will rise from around 27% currently to 35% in 2030 and 47% in 2050. They also predict that emerging markets capitalization will exceed the US by the end of this decade, with China in particular expected to overtake the US as the world's largest economy around 2035. This means that as emerging markets are set to account for a larger share, we wouldn't want to miss out on that growth. In addition, this chart from BlackRock shows how the US has performed against international markets in the past 50 years. The yellow bars show when the US has beaten the international markets, and the orange ones show the international markets have done better. But what this chart really illustrates is that there are some periods when you can miss out as an investor if you just pick one or the other. As you can see, although the US has dominated in the past 10 years, between 2002 and the financial crisis, international markets have outperformed. Now, I'm aware that the tech industry will continue to be a dominant force, and considering the abundance of tech stocks in the S&P 500, the future might be certainly different than how things were in the past. But this chart is just a reminder that things could change. The bottom line is that although investing in the S&P 500 is more diversified than buying just a single stock, it's still only reaching a small fraction of the thousands of potential companies available worldwide. Plus, as we saw earlier, this index alone won't provide you with a very diversified portfolio due to the concentration at the top. Personally, I invest in a global index fund because the US market already accounts for a large proportion of it. That way I ensure that I have exposure to all the markets in the world and benefit from wherever the growth is. But there are many other funds that I think deserve a place in every investor's portfolio. So check out this video next to learn about the best Vanguard funds that you can buy in 2024.